Welcome back. So by now I expect that you must have set up your trading platform and you are ready to get into the practical aspect of trading forex. But before then, we need to understand the terminologies that are used every day by forex traders so we could also catch up and be professionals about forex trading. And also we need to understand that these terminologies are also terminologies that will be used along the line as we continue in this course. So firstly on our list is candlesticks. So every candlestick has four major characteristics. It has its open, it has its close, it has its highs, and it has its low. The open basically represents the point at which the candlestick opens, that is the starting point of the candlestick, and the close represents the ending point of the candlestick. The high represents the highest point of the candlestick, while the low, as the name suggests, represents the lowest point price actually went within that candlestick time frame. And then this line we see on the candlestick that looks really tiny, it could appear at the top of the candle or at the base of the candle, and it could be called the shadow of the candle or the wick of the candle. So what exactly are these candlesticks I'm talking about? A candle is a graphical representation of price. There are several ways to view the price. There's the line charts, the bar charts, there are the dotted charts. However, the easiest to understand is the candlestick, and that is what we will be focusing mostly on. A candle pattern, a candle formation, or a combination of candle formations forms a candle pattern. So just like you have a key, and when you combine a key with other keys, it becomes a bunch of keys. Same way you have a bunch of bananas. When you combine a particular candle formation or a combination of candle formations, you then have a candle pattern. And then a combination of candle patterns also then forms a chart pattern. So just like in the body of a human being, we have a combination of cells come together to form a tissue, a combination of tissues come together to form organs, and a combination of organs form systems. So same way we have it on the candlestick representation of price. So a combination of candle formations gives us a candle pattern, and then a combination of candle patterns forms a chart patterns. However, I have certain candlestick patterns I'm going to be recommending for you that will be focusing mostly on as the course commences or as the course goes by. And I'm also going to be explaining why exactly I chose this particular candle patterns. So on my list I have the morning star pattern, the evening star pattern, hanging man, inverted hammer, the pin bar, the hammer, the bullish railroad, the bearish railroad, and the anchor candle. So you could always go on Google, or you could check the book posted in the private group on each and every one of these candles, how exactly they are formed, how exactly to identify them much better. So this is a representation of the candle patterns I just spoke about, but now we are grouping them into two distinct groups. The first group are the bullish candle patterns. Now I'm going to explain the term bullish later on, just stick with me. The first is the morning star. Now the morning star is a candle pattern that takes price up. So basically, as forex traders, price is either going up or going down. If you expect price to go up, you buy. If you expect price to go down, we sell. So when you see a morning star candle pattern, it means most of the time the price is going to go up. And the morning star pattern is more effective when you see it at the lower level in price. And the major characteristics of the morning star candle pattern is the third candle should close at least 50% or more above the first candle. So you see the morning star candle pattern requires 3 candles to be formed before you can then call it a morning star. However, another distinct feature of the morning star candle pattern is that the candle in the middle could be any type of candle, ranging from a doji, it could be a pin bar, it could be an hammer, it could be an inverted hammer. However, the candle in the middle should never be an anchor candle. So when you have a massive bearish candle, a middle candle, and then a massive bullish candle as well. Most of the time it represents a morning star pattern. And now to the armor. So looking at the shape of the armor candle, it looks literally like the normal armors we all know about. An armor is a rejection candle. It is a candle that also signifies that price is about to start going up. But one distinct feature we need to understand about the armor candle pattern is that armor only appears at the base of price. When an armor is at the base of price, that is when it has meaning and it represents that price is about to buy. And next we have the inverted armor. So the inverted armor, unlike the armor look alike, except that it just looks like the same armor candle now turned upside down, and this also appears at the base of price. So when you see this at the lower part of the price, then you know that most likely price is about to start buying. Next we have the tweezer bottom or the bullish railroad. Now the only difference between the tweezer bottom and the morning star is the candle in the middle of it. The only difference between the tweezer bottom and the morning star is the candle in the middle of it, which means the second candle in the tweezer bottom candle pattern must close at least 50% above the previous candle. Another name for the tweezer bottom is also bullish road, so we need to understand that, because along the line of the course I'm going to be interchanging the names. And then lastly we have the anchor candle. Now this is similar to the engulfing pattern so many traders know. However, why I like the anchor candle is it could appear anywhere on the price, and when you see a bullish anchor candle, it's a good representation that price is about to go bullish. Next we have the bearish candlestick patterns. So they are similar to the bullish candlesticks patterns, except that while the bullish candlestick patterns take price up, the bearish candlestick patterns take price down. So for the bearish candlestick patterns, first on our list is evening star candlestick. So just like the morning star, the third candle in the evening star has to close below 50% of the first candle in the evening star formation. And the evening star formation comprises of at least 3 candle patterns. So you must see at least 3 candles for it to be called an evening star, and it represents that price is about to go bearish or to go down. And then next we have the hanging man pattern. Now the hanging man looks like the armor, except that this time around it is located at a higher point in price. And as forex traders, our basic business is to sell high and to buy low, which means we sell when price is at a high price and we buy when price is at a lower price, much cheaper. So the hanging man pattern is just like the armor, except that it appears at the upper part of price. So when you see a armor at the upper part of price, you shouldn't confuse it with a armor, but you should automatically understand that it's an hanging man pattern. And then when you see an inverted armor at the top of price, it's called a pin bar or a shooting star pattern, and it represents price is about to go down. So from the illustration we see over here, you see price kept on going up. However, as soon as the shooting star appeared, price started going down. And then next we have the tweezer top. So tweezer top, another name for that could also be the bearish railroad. And like I said, for the tweezer bottom, the only difference between the tweezer top and the evening star pattern is the candle in the middle. So the second candle in the tweezer top must close at least 50% below the previous candle. And then lastly we have the bearish anchor candle. So just like the bullish anchor candle, this also could appear anywhere on the price, and it's a good representation that a bearish trend or price is about to go down. And next we have pips. So you keep hearing a lot of traders talking about pips, pips, pips. What exactly is pip? Now whenever you see a price on the candle, on the charts, that is on your trading platform, most of the time these prices always have at least 5 decimal places most of the time. Now what we need to understand is, since we deal with pips in the market, just like when we were much younger learning about units, tens and hundreds, we need to understand that the last figure in a series of price on the chart usually represents pipettes. So as forex traders, most of the time we tend to ignore that price. So pip basically means percentage in points or price interest points, however you like to put it. But the major thing is a pip is the unit of price measurement, and it represents the current position or the level in price. So take for instance, for human beings, we walk in steps, we move in steps. For cars, cars move in kilometer per hour. However, on the price, that is on the chart as forex traders, the market moves in pips. So you don't measure the market in terms of steps, you don't measure the market in terms of kilometer per hour. However, you measure the market in terms of pips. Now to count pip, just like I said in the previous slide, we need to understand the very last figure in the combination of the figures or the price points is representing pipettes. So we start counting 1 pip from the second figure. The third figure becomes 10 pips, the fourth figure becomes hundreds, while the fifth becomes 1,000. So example, these are a couple of price points right here: 1.24683 to 1.24693. If you subtract that, you realize you have just 1 pip. 1.24683 subtracted by 1.24783 automatically gives us 10 pips, and so on and so forth. And that is how pip literally works. So for lot size, we have basically 3 types of lot size, which are micro lot size, mini lot sizes, and standard lot sizes. For the micro lot size, it ranges from 0.01 lot size up to 0.09 lot size. However, you add 1 to that, it automatically becomes a mini lot size, which ranges from 0.10 lot size to 0.99 lot size. And then the standard lot size now is 1.0 lot size or 1.00 lot size up to, for most brokers, 500 lot size. However, for some extreme brokers, it could actually allow you to trade as much as 1,000 lot sizes. And lot size literally represents the volume being traded. So which means the amount of capital you actually put on a trade is determined by the lot size you are using for that trade. A lot represents the size of your trades in forex, and in other interpretation, lot is the number of currency units you will trade in the forex market per trade. So the volume you're putting on the line, say you have a $20,000 account, if you want to risk 2% of that, that means you need to calculate what lot size you would use. In other words, that will translate to 2% risk of your $20,000 account. So how exactly does it work? The amount of pips the market moves multiplied by your lot size then gives you the amount in dollar you are either going to make as your profits, or you are either going to make as loss rather. So lot sizes, we mentioned we have 3 types of lot sizes: the standard lot size, the mini lot size, and the micro lot size. So let's assume a standard lot size is 1.00. For every standard lot size you use, the market automatically translates, or your broker translates that to $10 per pip. So if you're using a mini lot size, it translates to $1 per pip, and the micro lot size translates to 10 cents per pip. So which means if you have 99.00 lot size running, it means your broker will be giving you 99 times 10, which is $990 per pip. As well as if you have 0.50 mini lot size running, it means your broker will be giving you $5 per pip. And if you have 0.08 micro lot size running, your broker is paying you 80 cents per pip. So a typical example is, let's say we take a trade and the market moves 10 pips in our favor, and we are using a lot size of 0.01. It automatically means that we are making a profit of $1. If we're using a lot size of 0.10 and the market moves 10 pips in our favor, we've made $10. And if we're using a lot size of one standard lot, which is 1.00, the market moves 10 pips that is 10 times $10, we automatically have just made $100. So the term bullish and bearish, you've heard me say over and over. What exactly does it mean? So bullish is known as long or is known as buy, and it's basically the upward movement in price. So if you want price to go up, or if you see price going up, you could say price is bullish, or you could say price is going long, or you could say price is buying. It all means the same thing, and just the same thing or the opposite of it is what is referred to as bearish. So bearish is when the market is going down, is known as short or is known as sell. It's basically the downward movement in price. So if you see price trending down, you could say price is on a bearish trend, or you could say price is going short, or you could say price is selling. And next on our list we have spread. So spread is basically the difference between bid and ask price, and spread usually represents the broker's commission. So take for instance, let's say I'm a vendor of say newspapers, right? If my supplier, if the media house supplies me say the newspaper for 10 cents, and then I sell it to my audience for 20 cents, the commission I've made, the profit I've made is the 10 cents on the initial capital of 10 cents which I actually purchased the newspaper. And this is exactly what our brokers also do to then make their money. So take for instance, you approach a bureau de change to buy a particular currency. What the average bureau de change does is they buy this currency from you at a cheaper price and then look for a buyer who would like to buy it from them at a more expensive price. So the difference between the price at which they bought it and the price at which they are selling it is the same thing the forex broker charges us as the spread. So bid represents the price at which the market is currently willing to buy, and ask represents the price at which market is currently willing to sell. So the difference between this is what our brokers then charge us as their own commission per every trade that the brokers allow us to pick. And then next we have commission. Now commission is also a type of spread, except that it is non-recoverable. Now this is the major difference. If your broker is charging you spread, soon as you place a trade, your broker deducts that spread, which means if you place a trade to buy, buying means you want price to keep going up. Immediately your broker gives you an entry price at a lesser price because the broker needs to take their commission, and then price needs to first of all, so take for instance, if your broker spread is 2 pips, it means that as soon as you place your order, the broker automatically deducts the equivalent value of 2 pips, including multiplied by your lot size from the trade you are in. So the market first of all has to go in your direction 2 pips for you to first recover the commission, the spread the broker charged you, before you then start counting your profits. However, in case of commission, the broker charges you, however, immediately you place your trade, the broker charges you that particular amount of commission, but the broker does not require you to make the market, to allow the market first of all go in your favor to then recover the commission the broker charged you. So that's the basic difference. So spread is recoverable. You just have to wait out for the market to first of all move the number of pips or the number of commission the broker has charged you before you then start making your own profit. However, for commission, the broker doesn't feed you in at a lesser price if you are buying. The broker feeds you immediately at the right price and then charges you a non-refundable fee, or a non-recoverable fee rather. And now for swap is the amount it costs the broker to hold a position overnight. And swap could either be against you or it could be for you. It could be positive or it could be negative. So in the previous lessons, we spoke about the types of retail traders. So obviously the scalpers and the intraday traders have no business with swap, because most of the time they don't hold trades over till the next day. However, the forex market every day closes around 10 p.m. GMT plus 1, which is actually when the New York trading session ends, and that holding a trade within that time or after that time is what then attracts the broker to charge you swap. So take for instance, you are on a trade, maybe Euro USD, and you leave it overnight. If it costs your broker money to hold that position for you overnight, then the broker charges you the swap in negative. However, if your broker is making money by holding that position for you overnight, then apparently your swap will be in positive. So the broker will share the profit or the loss involved in holding that trade overnight for you, and that is what is referred to as swap. And now for leverage, credit broker offers traders to increase traders volume is basically what is referred to as leverage. So like a standard businessman, if you need to make a increment in your supply chain, if you need to expand your business and you need to take a loan, basically you walk into a bank and you require collateral, and they require collateral before they then offer you a loan. But as forex traders, we enjoy leverage free of charge from our broker. Now this leverage does not affect our capital, it does not affect our account balance, but what the leverage does is it allows us to trade a larger amount of volume. So some brokers offer leverage as much as 1,000. So brokers offer leverage of 1:500, and some brokers, their highest leverage offered is 1:100. So basically what it means is, take for instance, if you fund your trading account with $1,000 and your broker offers you a leverage of 1:100, it means your broker would allow you to trade a volume of up to $1,000 which you deposited times 100 of that $1,000. So you could actually open trades and use up to that volume as if you had up to that amount. So basically that is what leverage works for, and that is one major advantage we enjoy as forex traders. And then we have the margin. So margin is a function of leverage. If your broker doesn't offer you leverage, then obviously you are not trading with margin, and margin is the percentage of your equity needed to keep a trade open. So which means, since the broker has matched up your trading capital with some form of leverage, the broker also needs an insurance policy that you as a trader must have in your capital before you then open a particular trade, and that is what is referred to as margin. And next we have equity. So just like the name implies, so many of definitely you should be aware of what equity means. Equity is basically the account balance including the value of open positions. So if you have a running trade, your account balance plus or minus your running trade. If your running trade is in positive, then your equity will be your account balance plus the total profit that's running. And if your running trades are in negative, then your equity becomes your total balance minus the running trades. And then your balance is actually the amount you have with your broker, the original amount subtracted from whatever is running. So whatever is running, whether in profit or whether in loss, doesn't actually affect your balance. Your balance doesn't move, it doesn't shake until you then close a trade. So while the trade is running, it's your equity that keeps changing, because your equity considers the profit or the loss of your open trades. However, as soon as you close those trades, they then turn into balance. And lastly, we have the stop loss. Stop loss means the maximum risk on a trade. So one thing we should understand as forex traders is the forex market, or forex trading as a business, is one of the most risk-free businesses in the world. Reason being that as a forex trader, you could actually determine exactly, in fact up to the tiniest cent, how much exactly you will be willing to lose should in case you make a wrong trading decision, or should in case the market chooses to go against you. I don't think there's any other business in the world that affords business people that much risk management. So stop loss for every trade is the value you set on your charts, is the pip value you set on your charts, that should in case I am wrong in this trade, I don't want to lose more than this. So take for instance, say you're using a mini lot size of 0.10, you could set your stop loss to maybe 20 pips, which means $1 times 20, that's $20. So automatically your risk on that trade becomes $20. And next we have take profit. So take profit requests that for every trade you place, you have a maximum point on your chart that you actually have chosen, that if I'm in profits, I don't want to make more than this profit. So take profit simply refers to the maximum profits you can make on a trade. So take profits basically means you've placed your trade, you expect price to go in your favor, you expect markets to go in your favor. So at what level would I need to exit if market goes in my favor, or if price goes in my favor? Now we should understand as forex traders that so far you set your stop loss and you set your take profits, you don't have to even have your MT4 or your trading terminal running. So far you've placed your stop loss or your take profit. When price gets to either of these levels, automatically it fills you in and you are out of the trade. If it fills you on a stop loss, it means you've lost on that trade. However, if price fills you on a take profit, automatically you've closed that trade in profit and it will be added to your account balance. Now next, the entry price is the price at which a position is filled. That is the price at which your broker took you into an open trade. And current market price refers to the position of price at any given moment. So you open any of your charts right now, the current price at which the bid and ask price is at the moment refers to the current market price. Thank you so much, guys.